Hi, everyone. My name is Lakshmi Aldridge. I'm the dermatology nurse practitioner, president of the SDNP, and I'm delighted to welcome you to this month's webinar series. We're going to take a little change from what we usually do, which is almost always clinically focused. Tonight, we're shifting things a little bit to talk about something that I think we all worry about at times and definitely did not get any information on in any of our graduate NP programs or even afterwards. So we are delighted to be getting some experienced speakers talking with us this evening about financial planning for medical professionals. We could not do this without the generous support of our sponsors for doing presentations such as this. So I really want to give a shout out to our friends at Lilly who have been gracious in providing the funding for all of our webinars through 2021 and 2022. So thank you so much. When you do see your Lilly colleagues, please be sure to thank them for supporting dermatology NP education. And with that, I'm delighted to introduce our two presenters for this evening's presentation, LeTian Dong and Tom Morris. Both are exceptional and outstanding financial planners. LeTian is going to share her experience, but just a little bit about them. She's the co-founder of the boutique financial planning practice housed within Northwestern Mutual with her partner, Tom Morris. Both of them are very passionate of providing education about financial management, specifically for medical professionals. So with that, I'll turn it over to LeTian and Tom. Thank you so much.
Thank you.
Thank you, Lakshmi, for the introduction. Hi, everyone. Good evening. Like Lakshmi said, both Tom and I are very passionate about doing financial planning, especially when it comes to working with medical professionals. My husband is a doctor, my mom's a nurse, and Tom is also from a family of medical professionals as well. So we find ourselves very involved. So tonight we have a presentation that's originally geared for an hour and likely will bore you to death, so we won't do that. So we'll move relatively quickly. And again, some of the slides may not be fully applicable, so we will want to save some time at the end for your questions. And if there are any questions that we don't get to or get to the level of details that you wanted, or you have a question that's sort of personal, feel free to reach out to us. Our contact information is on the screen, and we can always send that out afterwards.
As LeTian was saying, so my background is both of my parents were physicians. I have two sister-in-laws who are nurses, and have been in the around the medical field pretty much my entire life. Well, actually all my life. So one of the things that I've found about medical professionals are there a lot of unique financial challenges that that you have that other people don't. A lot of it caused by a very long educational process to become a medical professional. And so there's a huge amount that we can go through. So similar to flying a plane, we have all these things that we need to pay attention to. We can't teach you to fly the plane tonight. So the big thing that we're going to try to do is get ready for takeoff and just cover a few of the real basics. You know, how fast are you going down the runway? What are your flaps set at? How much fuel do you have on board?
So more specifically, we will focus on the 4 core areas of financial planning. That's budgeting, managing student loans, protecting your income and lifestyle, and saving for retirement. These are great places to start, and let's get going.
Yeah. So the big bad word that nobody likes is budget. But if you think about it as just being, you know, deciding how much you want to pay for different things, it becomes a little easier. Do you really want to pay $300 per month for your cable bill, right? Most people don't get that much enjoyment out of it. So even if you don't budget up front, if you come back and look at where you're spending the money, if you track it, you can actually decide that was either that was really worth it or not so much, right? I didn't get that much enjoyment out of it.
So one approach that we recommend, it's called the 20-60-20 approach. So notice that it doesn't say 20-60-20 plus another 20. So if you have an income of $1,000 a month, don't spend 1,200. Live below your means. So if we look at the chart, easy thing to think of is 20% of your income right off the top should be saved. And then 60% maximum allocated to essential expenses, so core living, and that includes student loans and debt repayment. And the key really is to reduce that 60% because the more you can reduce that 60% piece of the pie, the more you have left over for the other 20%, which is the discretionary spending piece. And that is a lot more fun. And definitely keep in mind on what goes into that 60%. So if you're going to buy a bigger house, that's a long-term commitment. You can't get out of that. Buy that Mercedes, same thing. So people usually don't overspend on food. And if they do, it's easier to make that lifestyle adjustment. So a good rule of thumb on these larger purchases is if you can afford to buy two, then you can buy that first one. On the right-hand side is a budget worksheet, and we can be happy to send that out afterwards. So something quick to track down what's going on a month-to-month basis. So the next section we'll talk about is managing your student loans.
And a lot of people with their student loans feel like this. They're just drowning. They can't seem to get out from under them. And so there are a lot of ways to address student loans. But you end up for a lot of medical professionals with some pretty hefty loans. So.
And then you may not have the amount of loans for physicians, but as nurse practitioners, the statistics are there too, that there are a lot of loans, especially newer graduates. So we want to give a quick overview of there are definitely options out there. And the key really is to find the option that best fit your situation. So if we talk about repayment options, they really can be broken down into two basic types, traditional and income driven. So traditional repayment plans look at how much debt is owed over the period of time it will be repaid, and then you pay the same amount every month. So pretty simple. And on the other side, with income-driven repayment plans, your monthly payment are calculated as a percentage of your discretionary income. So you pay less now and more later as your income grows. One of the things that I want to bring up is public service loan forgiveness. So that's another factor to consider, right? The possibility of having your loans forgiven, which is sometimes possible with income-driven repayment plans. So what this means is if you work in a public service and meet certain of these criteria, as you see on the screen, you may be eligible to have your loan balance forgiven. So there are two main qualifications: must work for a qualifying entity and make 120 payments or 10 years of payments. And naturally, as with anything government related, there's paperwork involved. And below, there are additional resources. Feel free to take these down. Studentaid.gov has a really complete list of information available about all these loan options to help you make the right decisions. GradFin, they are a private company. They're student loan consultants. So they can work with you one-on-one to find a customized path for you and help you make informed decisions on what the right what the best decision is for you. And if you don't qualify for loan forgiveness or are not using an income-driven repayment plan, you might consider refinancing your student loans. So there are pros, likely better interest rate, which could give you some financial breathing room and save you money in the long run. There are some drawbacks. So if you refinance with a private company, you'll no longer have federal loans and then the options and advantages that come with the federal loans. So for example, the pandemic relief policies like the CARES Act put most of the federal loans on administrative forbearance that paused monthly payments and without incurring interest or penalties, but that did not include private loans. So again, sources at the bottom, Graphend is one of them, and also Splash Financial. They also have really good resources. Okay, so we will move on to protecting your income and lifestyle.
So sometimes your plan B determines the quality of your life. So you want to be prepared. It's never a fun topic, but it's a good thing to make sure that we have the bases covered. So things that are that we really need to worry about is the first one is being sick or hurt and not being able to work. Right. So 1 in 4 people in their late 20s will not be able to work for more than 90 days at some point during their career, right? So that's something that you need to be prepared for. Because sometimes you go out and there's a reasonable chance that you never come back, right, to work, and you don't want to be without income for an extended period. The second one is, if people are dependent on you, then if you die, we need to make sure that they are taken care of. And the last, and probably one of the most important that gets overlooked, is having an emergency cash reserve. And that allows for little bumps in the road, sometimes relatively big bumps, that you have a way to deal with those without taking on credit card debt at 22%.
So on protecting your income, so let's think through this very simple math. Average lifetime income, let's say that's $100,000. And if you work for 30 years, that's $3 million. How many of you in the room have $3 million just lying around, right? So your future earnings is oftentimes your most valuable asset. This 1 in 4 disabled statistic, this is Social Security general population number, right? Medical professionals often, unfortunately, have a higher statistic than that. So on the positive side, you probably have group insurance through your employer, which actually is relatively weak. What you want to do is to pair that up with a fantastic individual policy. And if you want great coverage and great protection, don't expect to pay $5 for a great comprehensive coverage policy. Insurance companies are on the hook for that $3 million we talked about. So you're protecting your most valuable asset. Don't go cheap. And again, not wishing for anyone to file a claim, but if you need it, you will want the best policy that you can get. And you expect to pay about 1 to 2% of your income for a good policy like that. One of the things we recommend is work with a professional from one of the big mutual insurance companies like Mass Mutual, Guardian, Northwestern, all make good, high quality products. And let's move on to saving for retirement.
So, there's a lot of studies that say that nobody likes to talk about retirement because they think about it as being on a front porch in a rocking chair and not being active. So think about it as financial independence. So what that means is you can spend your time with whom you want, doing what you want, without regard for the income that generates. So I have a lot of clients who love to work and could afford not to work for the rest of their lives, but they get a lot of enjoyment out of it. And that's great. So you want to get to that point as soon as possible because work becomes much more fulfilling when you don't have to worry about the income that it generates. So I've had a few clients where they said, I can't stand my job. I want to, quit as soon as possible. They get to that point and I say, congratulations, you're there. Now you're working for your grandkids. And they continue to want to, wow, wait a minute. So I can put up with this for another couple of years for my grandkids. I just can't put up with it for me. So
That's right. And then Tom, one of the things on the flip side I want to add is, yeah, we don't want to be the very few clients that some clients we do run to where they are forced to work because they have to. Not a really great situation to be in. So want to catch things early, right? Be prepared.
great point.
So quick statistic, most medical professionals list retirement planning as their top financial concern. So you can see retirement's one of very big priority on top of a lot of people checklists. So again, for anyone who doesn't have that extra 3 million lying around, right? Okay. So one of the things that I learned, Tom's daughter learned, and a lot of my peer young professionals is you have to start early. Again, you don't want to be that professional working at 70 or 80 because they have to and pretend they like their job, right? And by the way, life doesn't ever turn out exactly the way you plan it. So definitely start saving now and start saving early. The chart on this page to show you the power of compounding over time. So let time be on your side. The sooner you start, harder compounding can work for you. All right, quick overview on where to put your money. So there are different ways to save, and the thing to keep in mind is you want to have a mix. We don't know what tax rates are going to be like 10 years later, 20 years later, 30 years later, right? So you want to have a mix of different type of money, because really the thing you will pay the most in your life is probably taxes. So saving into different, we call them buckets of money, that gives you the flexibility down the road to pull money from different buckets, if you will, depending on the tax situation at that time. And again, going back to rule of thumb, save that 20% right off the bat. The best way to do that is to create an automatic saving strategy. And one thing to point out is that savings should happen as a simultaneous funding goal as paying off student loans. So you don't want to wait until all the loans are paid off and then start saving for retirement. That's oftentimes too late. Going back to the whole let time be on your side and work the compounding for you. Yes. And when you look at your programs through your employer, a 401k or 403b, most of you will have access to an employer sponsored retirement plan. Definitely take advantage of those. Most of the time, your employer offers a match. So that is free money, right? So at least contribute the amount into your 401k or 403b to get that match, to get that free money. All right, so you may heard of your favorite uncle, Uncle Sam, tax man, right? He always gets his cut, but he tried to give you some perks. So let's go over the two main types of tax qualified accounts. In a traditional IRA, so what happens is you don't pay taxes going in. The money grows tax deferred, and when you take it out, all of the contribution to a traditional IRA may be tax deductible depending on your income and whether you participate in an employer sponsored retirement plan. So similar to a 401k, so earnings on a traditional IRA grows tax deferred. So you don't pay taxes year after year, but when you take it out, that money is taxed. So you generally, for a traditional IRA, you can contribute up to $6,000 per year with an additional catch-up contribution of $1,000 if you're over 50. Okay, on the other side, Roth IRAs is you pay taxes now. So pay Uncle Sam now, put the money in, it grows without tax. And when you take it out, it's also tax-free. So since contributions made to a Roth IRA are made after tax, they will not reduce your taxable income today. However, your money grows tax deferred, and then qualified distributions from Roth are generally tax-free during retirement. So this would be a good option if you think you'll be in a higher tax bracket when you retire. Or again, like we talked about before, you want some tax diversification across your assets and your holdings. So a lot of the popular question that we get is Roth a better idea? And the answer is generally yes. If you're young and starting out in your career, you're probably in the lowest income bracket currently, but really you should have both. So on investments, we will do a quick overview of this. Stock market is a roller coaster. Let me just throw that out there. One of the rules of thumb we want to remember is buy low, sell high, not the opposite. So don't sell at a loss. You don't want to sell at the bottom of the market. And you don't want to put yourself in a panicky situation. So if we think back to March, April of last year when the market just plummeted, a lot of people sold their assets from the market and held it in cash since then. Definitely don't recommend doing that. So really the one of the biggest risks to your retirement portfolio is it's your emotions. So when it comes to investments, really it's a strategy game. Set your strategy for the long term and let it do its thing. Do not let the emotional roller coaster of the stock market up and down affect your decisions. And it's hard doing that by yourself. So the risk is also not having a qualified professional that you can talk to, because again, you help your patients through their medical issues. Similarly, you should talk to a financial planning professional to help you through these key, major, important financial decisions in your life. All right, so I know we ran through these relatively quickly, so we and covered a lot of ground with these 4 areas of planning. And again, this gives you a great place to start to build your financial future.
And so we talked to you a little bit about how to fly the plane. But I think part of it as well is, would you like to try to be the pilot, or would you like to just enjoy the trip? So for a lot of people, they just want to get there and get there in comfort. So a big thing is hire somebody who knows what they're doing. So that generally is going to be a CFP professional. We're both CFP professionals. If somebody isn't a CFP, it doesn't mean that they don't know what they're doing, but if they don't have substantial qualifications, then they haven't been at it long enough, is one way to look at it. So a certified financial planner has at least a minimum level of competence across a wide variety of situations. And if you go to the CFP site, you can actually search by your local, wherever you are, to find CFPs in your area. Oh, that's right. And thank you for for today. Please, we saved a lot of time here. So how about giving us a couple of tough questions? So thank you very much.
That was a fantastic presentation. I've never seen it, heard it done so succinctly and so easily, so to speak. You make things sound very easy. So really want to thank you, first of all, for being here this evening before the holidays to share this information. I want to make sure that all of the panelists and attendees, if you have any questions, please put them in the chat box, and I'm happy to relay that to our speakers.
LeTian and Tom, I had one. Just kind of thinking about the unique kind of challenge. There are unique challenges and opportunities for this audience. So, I would imagine that there's more personal risk and professional risk, and balancing those two things. So, do you have any thoughts in this area for the nurse practitioner community?
LeTian, you want to take that one?
Amy, can I ask a clarification question?
Yes, of course.
When you say personal risk and professional risk, specifically what came to mind?
So I think about like you kind of talked about the potential for like injury or disability in the workplace. I know this is, dermatology nurse practitioner, so there's, they're not, typically in the ER or something like that. But you still have some of that. And then I also think about like, you think about that, and then the risk of litigiousness or malpractice or those sorts of things that you would want to be planning for in this community that, the typical 9 to 5er is not going to be experiencing. Probably a lot of the spouses or partners or peers of folks in this community don't know about that. So when they're looking for financial advisement, what should they consider in those areas to make sure they're well protected?
Absolutely. So one of the things that first came to mind, and this is, I guess, very often that we experience, is when we walk through and review their existing plan and make sure we create a bulletproof or as bulletproof as possible scenario for them, is that what Tom mentioned when it comes to disability insurance is to have a policy that is that have the definition of disability matches exactly what they're doing. So again, if we, Tom, you can supplement to this point, because a lot of times with group policy, it's a general definition of disability. That means if you can work and make money flipping burgers at McDonald's, right, then you're not considered disabled. So being medical professionals, you have a niche skill set that you have, and having a policy, or really think of insurance as offloading that risk to a bigger company in a way that that you really covers your specialty and your skill set.
So yes, great answer. See, I knew there was a reason I've been working with you for 7 years.
Thank you, Tom.
By the way, to say something about her, she, LeTian, last month won an award where she's considered one of the, from the American College, of being one of the top 6 next generation financial planners across the entire country. Right. So,
Thanks, Tom.
That's
yeah.
amazing.
And yeah, disability is probably one of the most complex products that you can buy from a financial, right? Life insurance, if we're looking at just term life insurance, claims are really easy, right? It's which side of the grass are you sleeping on tonight is sort of how that works. Disability is very complex because it's what is the definition of disability. So usually in a group policy, you'll run into things like there's no inflation. So if you're sick or hurt for 30 years, that's a really big deal. It can be usually on most policies, they'll protect you in your own occupation for 2 years, and then it's any occupation, right, that qualifies. There's oftentimes stuff really buried deep down where they can reduce your benefits over time. So once you're out of the workforce, you oftentimes sort of become invisible to all your coworkers. So the times in a group policy, they're concerned about the first couple of years, but then you're sort of on your own, which is the reason it's important to have to pair it with a really good personal policy. So, so do we want to take someone want to read one of the other questions?
Yeah, I'll read off another question. We've got some great ones in the chat box. How much can one expect to spend for the services of a CFP?
Between something and a whole lot. So the key here is it should never cost you to have a first conversation, right? Because you want somebody who's competent, but you also want somebody, probably the biggest thing long term is, are they a match for you in your situation? If you sit down and you come out of the room or out of the Zoom meeting and you go, going to the dentist was less painful than this, then that is the wrong person. I don't care if they're charging you nothing, you don't want to be there. However, we all that are in the profession need to make money. And the biggest thing is to understand how that compensation is. Somebody who is younger is going to generally cost less than somebody who has 30 or 40 years worth of experience, right? But you'll figure that out just by talking to somebody where they're a fit. So you should probably interview a few of them, right? And they should be very transparent on how they get paid. If they say, well, you don't pay me, then that should sort of throw up a red flag. So it could be that they are getting paid from a product sponsor, if you will. Sort of like this presentation is being sponsored by Lilly. Thank you very much. But you need to understand how that works, right? So if I just relay that to myself, I work in 3 different ways. One is from a compensation. One is I just charge a consulting fee. Everybody knows that before we start, this is how much it's going to cost to get through us figuring out these things that you're concerned about. The second is I can get paid for because you need something such as disability or life insurance or mutual fund, whatever it is. And the sort of like a car, the cost or my compensation is built into the cost of that, right? My big thing is anybody who wants to know, I will tell them how much I'm going to get paid for anything that I'm recommending. And any good CFP should volunteer to do that. Or if you ask them, will they do it? They shouldn't hem and haw. Well, it's yes. The answer is yes, you should. The last way is we do assets under management. So basically a quarterly fee that's a percentage of the assets that we manage, right? That doesn't really work when you have $1,000 for us to manage, and so it takes a while to get there. So, LeTian, is there anything that you think would be good to add to that? Let me rephrase that.
Good.
What do you think would be good to add to that?
Well, Tom, you always say I get into the weeds a little too much. So, right. But adding a little bit to the weeds, generally, if we're thinking about doing consulting engagements, one of the rules of thumb is we charge around 0.5% of income and plus 0.25% of assets. So if you want a ballpark number in your head, if you're a detailed person like me.
So you said 0.25% of the income
assets
and 0.5%
of income.
Of 0.5% of the income and 0.25% of the assets.
Mm-hmm.
Right.
And is that per year or once or?
It really depends on what somebody's trying to accomplish, right? So the way that we do it is we decide what are you trying to accomplish, right? There's a reason that you came in the door and asked to talk to us. So it's solving that problem, sometimes which will be 4 or 5 or 8 meetings, right? Just depends on how complex it is. Then from there, the way we do it is it also puts us on a retainer for the balance of a year. So if it takes us 2 months to go through to help create a financial plan and how much is it going to cost to retire, to fund my kids' education, all of those types of things, then when we sign the agreement, we cover for a full 12 months. At the end of the 12 months, someone can decide if they want to hire us continuously, ongoing, or whether they're going, okay, I'm good here. Maybe, I'll come back when something changes, right? Or something major happens in my life, or I just want to sort of make sure I'm on track. So we have people do it all sorts of ways. It really should be flexible to whatever you're looking for, right?
Thank you.
Does that answer your question?
I hope so. It was from the group. Another question from the group, please explain the income requirements for the different Roths.
Sure. My type of question. Again, I'm so detail oriented. So it changes a little bit every year. So for 2021, Roth contributions, if you're single, the contribution phase out starts at 125,000. And if you're married filing jointly, that phase out starts out at household income of 198,000. Every year, every few years, that number kind of bumps up a little. So again, tax planning, and then again, going into the weeds a little bit, one of the strategies that we a lot of times use, and again, may or may not be right for your situation, but one of the strategies we use is what's called a backdoor Roth. So if you don't have an IRA and all of your pre-tax savings is in a traditional 401k, then you can open up a new IRA, fund the set $6,000 for 2021, and immediately convert that into a Roth IRA if your income is too high. So contribute to a non-deductible IRA, then flip that over to a Roth.
Another
And
question. Oh, go ahead.
Hold on, just expanding on that because, you know, we're
Sorry,
gonna
I
have a
think I went
competition of
from.
how much in the weeds we can get here. So we'll have a vote at the end here. So the other thing that you can do, and people often don't know this, is you can use a Roth 401k. Many employers have them, and in that environment there is no income requirement or income max, right? On any retirement plan, you do have to have income, right? So so Amy cannot fund a Roth for her son, right? Because he doesn't have earned income, right? Now, if she pays him to take out the garbage and pays him a lot, then he could fund one. So
Thank you.
Don't give them any ideas.
Yeah. Another question from the group. Do you work with complex scenarios with 1099 independent contractors in medical practices and also a co-owner of a related but separate med spa?
Yes.
I like that story.
So my background is I've been doing this now for a little over 17 years. Right out of college. No, a little gray hair here. I started 4 companies while I was in college and then did 10 startups after college. So within Eastern North Carolina, we were going to be the business and estate planning specialist. So I do a lot with deferred comp. How do you maximize stuff for the owners, right? What do you need to do for all the team if you're that way? Can you set up something where, for example, I have one where we have a CEO that business owner was wanting to retire but didn't want to sell his business, and so he put in a CEO, and if that CEO retired from the company, he would get his base salary for the first 10 years. Now that is not standard, right, compared to money things. So I actually love complex situations because it gives me something to noodle on and to figure out, right? So
this kind of goes along with that question because we get this a lot. A lot of dermatology NPs will serve as consultants or receive honorariums or 1099s like they were, the previous question implied. Do you recommend that that NPs set up a separate, like a separate LLC or something else for that income versus counting it as just their regular income? Or what recommendations do you have for that?
So effectively, if you have a 1099 of any type, right, then you're an independent contractor. I mean, almost by definition. But if you're running a separate company, one of the first questions I would ask really two. One is, what's the liability? So is that income going to create a liability? So for example, if you were going to be an OBGYN, there you've got massive liability with that and massive trails. So you would probably want to protect yourself and have that company incorporated in some fashion to protect yourself from liability, right? And the larger the chance of a liability claim, the more protection you would want to have. So we often run into situations where people will have multiple operating companies because they don't want a problem in one to take out everything. So for example, think about a rental house. So if you have 5 rental houses and none of them are in a company, then your entire net worth is exposed, right? So I could take all the houses and put all 5 of them into one LLC. Well, my net worth is protected except for all the real estate. I could go one step further. Of course, costs get a little more, and I could have each house in its own operating company. So if somebody slips and falls in one house or dies in a horrible fire accident, right where I was liable, okay, they would get that, but my other 4 houses and my net worth are protected. So that's one thing, is liability. The second is tax planning, right? So if you have a 1099 and I'm running it through a business, even if it's not, an LLC, there are things that I can do and I can write off, right? So I can probably write off part of my car, or maybe, a room in my house. Don't necessarily recommend that, but there are things that you can, in fact, write off very legitimately, right? If you write off the room in your house, you're asking for an IRS audit, right? To a large degree. But generally speaking, it allows you to deduct a lot of things that you wouldn't be able to deduct without it. So, LeTian, do you have anything to add to my weeds?
Tom, this isn't a competition, right?
So, all right, that's fine. So do we
And
have,
great answer.
yeah, all right.
This was so incredibly helpful. Are there any questions from the group? I think that those are all of the questions that we have. We will definitely, excuse me, the information is so overwhelming and wonderful. I'm getting choked up over it. We will definitely make sure that your information is on our website to share with all of our members, and they can reach out to you for further information. So both of you, thank you so much for spending the evening with us and sharing this incredibly valuable information for us. And with that, I would also like to just make a quick shout out for all of the folks on the call tonight, reminding you that we are having our first live SDNP annual conference in Nashville, Tennessee in April. Hopefully all of our COVID worries will have gone by then and we will truly be able to celebrate. But if not, we are going to make appropriate accommodations in case we are still in the pandemic mode. But I hope that we will be able to meet together as a group, live face-to-face, to share more valuable educational content. We will also be having our first certification review course immediately after and in addition to that symposium for anybody who is interested in that as well. More information coming on that. So with that, I just want to thank again our wonderful speakers, LeTian and Tom. Thank you so much for being with us. Wanted to also give another shout out to our sponsors at Lilly. And I want to thank all of you Derm MPs for what you do every single day, for working so hard during this pandemic and taking care of patients who desperately need us, especially now, and for all that you do. And I hope you all have a safe, happy, and healthy holiday season. See you in the new year. Take care.